Now I quickly move to the 45.3. A partner of a partnership firm or a member of a AOP or a member of a BOI, body of individuals, introduces a particular capital asset as his capital contribution into that particular partnership firm or into that particular AOP or into that particular body of individuals, capital gains do arise. In whose hands? In the hands of that particular partner. Partner is introducing the capital asset as his capital contribution, right? Law is kind enough. At least here it is not saying what is the fair market value on the date of introduction of such capital asset into the business, that you take it as a deemed sale consideration, and that difference you ask the partner to pay the tax is not the point. The value at which it is being recorded in the books of accounts is a point. Let us suppose I purchased an asset with 50 lakhs. I gave that particular asset to my partnership firm. On that date the fair market value is 100 lakhs, but we asked the firm to record the same at 60 lakhs. Now I am asked to pay the tax on the difference of 60 lakhs and 50 lakhs only. Got the point? So write down 45.3. Capital asset being transferred to firm, by the partner as capital contribution, then deemed sale consideration is the amount at which such asset is recorded in the books of accounts of the firm. Yes. Here there are some beautiful questions, right? Write down. Take one question. Mr. A is admitted as a partner in a firm, measures XYZ. He transfers unlisted shares on 1/2/2012 as his capital contribution the fair market value of unlisted shares is 50 lakhs. But the firm recorded the value as 30 lakhs. Next. The unlisted shares were acquired. acquired by Mr. A on 1/1/2002 for rupees 10 lakhs. Friends, our income tax law and the provisions in it can be compared with Anacin tablet or Amrutanjan or Zendubam. What is this, sir? क्योंकि पहले आपको ये जंडूबाम और अमृतांजन और एनासिन टैबलेट क्या है आपको फर्स्ट उसको इंफॉर्मेशन देना पड़ता. When Krishna Reddy gets headache, he can have Amrutanjan or Jandubam applied on the head and take an Anacin. But he gets immediate relief, but not a permanent relief. After the effect of the tablet is over, again headache is coming. Right? So when the law gives any benefit, it is only temporary benefit, not the forever benefit. The moment Anacin tablet effect is over, again how you got the headache, like that only here also. Here what you are saying, बड़े दिलवाले के जैसे income tax law says, no, don't touch the fair market value. Happy well, what is recorded, that recorded value you take it as a deemed sale consideration, and from that reduce the cost of acquisition or the indexed cost of acquisition. The same beautiful law brought another section called as section 56(2) clause 7a. Says what? If any person transfers to any other person any asset either at free of cost or at a concessional rate or at a concessional value, that difference, what will happen? Will become income from other sources. Will become income from other sources. In whose hands? Recipient hands. In whose hands? Recipient hands. यदि एक 50 lakhs fair market value of the asset को with good heart, kind heart, not good, kind heart, if I give it to Mr. Krishna Reddy for 30 lakhs, yes, my problem is over. मेरा deemed sale consideration is only 30 lakhs. मगर कृष्णा रेड्डी को फ्री में ये asset 20 lakhs benefit आए. In his hands, the law says this difference between the fair market value and the sale consideration should be taken as income from other sources. Right? Because an asset whose value is 50 lakhs, if I am giving to Mr. Krishna Reddy for 30 lakhs means Krishna Reddy is not my damad. Gift देने के लिए. Nor my brother-in-law. Got the point? क्यों दे रहे हैं? उन्होंने ब्लैक में दिए. Right? So we have to punish. We will catch hold of Mr. Chakravarti at a later date, because this 20 lakhs which he gave it to Mr. Chakravarti, he might have invested somewhere, that we will catch hold and that we will punish. We will also punish for having received like this, because the 20 which he paid is from his undisclosed sources. So that is the reason why we say that is your undisclosed income के जैसे. So law says what? Do but do carefully. फेयर मार्केट वैल्यू से बिलो कर रहे हैं बोले तो क्या है, ये इधर यू आर टेकिंग इट इन द ब्लैक और ही इज पेइंग टू यू इन द ब्लैक. अदर वे अराउंड between two non-related people, why a fool will make transfer when the fair market value is at 50 lakhs at 30 lakhs? Got the point? So this point, whether you are going to write or not, they are going to test. At PCC level, if this question is going to come, if you simply write from the point of view of the partner, what is it is enough. But once you come to the final level, we expect you to have overall grip over the entire law. Take the important points here. That is, in the computation of capital gains in the hands of Mr. A, computation of capital gains in the hands of Mr. A, sale price as per section 45(3), sale price as per section 45(3), 30 lakhs. Less indexed cost of acquisition, 10 lakhs divided by 426. What is 426? Index of the year of acquisition, one, that is 2001 and 2, divided by 426 multiplied by 785 makes it to 18,42,723. The resultant difference is 18,42,723. The resultant difference is 11,57,277. This is okay, this you can do, but the next point you write, section 56 subsection 2 clause 7a as introduced by the Finance Act of 2010, as introduced by the Finance Act of 2010, is attracted since the said section applies when unlisted shares are received by closely held company or the firm. Accordingly, firm need to offer the difference between fair market value and the amount at which it is recorded in the books. Fair market value and the amount at which it is recorded as income from other sources, as income from other sources. Continuing with this particular discussion, friend, tomorrow let us suppose this particular company or this particular partnership firm want to make sale of this particular asset, then the cost of acquisition is what? Not the amount recorded in the books, it is a fair market value, right? That also you note. The cost of acquisition in the hands of the firm, the cost of acquisition in the hands of the firm shall be taken as rupees 50 lakhs, shall be taken as rupees 50 lakhs. Right. Then friends, I don't expect you to write this particular question because of the time factor. Listen carefully, because problem is big, there is a point in writing. Mr. Anwar is admitted as a partner in a firm measures XYZ. He transferred a building on 1/1/2012 as his capital contribution to the firm. The stamp duty value of the building is 50 lakhs, but the firm recorded the value of the asset at 30 lakhs. And the building was acquired by A on 1/1/2002 by Mr. Anwar on 1/1/2002 for rupees 10 lakhs. Discuss the tax implications. With respect to the land and building, we have a provision called as 50C. That 50C says what? If any asset is transferred at a value less than the stamp duty valuation, stamp duty value shall be deemed to be the sale consideration is the point. Accordingly, in this particular case, although section 45(3) says it is the amount at which it is recorded in the books, very well 50C provision can be well invoked, and it can be very well be done with in this manner. But here two parties are getting affected. At least in the earlier case, it is only the firm which is offering 20 lakhs as the, what is it, as the income from other sources. At least partner is scot free. Amount at which it is recorded minus indexed cost of acquisition only, he has offered it as a long term capital gain. But in case of the building, 50C provision, once it gets invoked, on one hand the partner is getting affected, on the other hand in the hands of the company, in the hands of the company, in the hands of the firm, will it be again taxed is the question. For that what we say, 56(2)(7)(a) is not is attracted only when the asset transferred happens to be the shares of a, what is it, unlisted company. These provisions are not applicable to the, what is it, the building, thanks to the law. Right? So write down important points what you have studied here. When a building is transferred by a partner, when a building is transferred by a partner, to the partnership firm, and the firm recorded the asset at a value less than the stamp duty value, then 50C will override, then section 50C will override 45(3), and accordingly we should take the stamp duty value of such a building as a deemed sale consideration. And calculate the gain to be taxed in the hands of the partner. Next, provisions of section 56 subsection 2 clause 7 is not attracted. Why? Because that provision that for inadequate thing, if you are going to purchase, is only applicable to the individual, and HUF. In this case, who is the recipient? Recipient happens to be a partnership firm. So your 56 to clause 7 is not applicable. Even your 56 to clause 7A is also not applicable, because 56 to clause 7A is only in case of the shares of the unlisted. Got the point? So section 56 to clause 7 is not attracted, since the said section applies when property is received. When property is received by the individual and HUF, and not in case of partnership. Then section 56 subsection 2 clause 7A is also not attracted, because section 56 subsection 2 clause 7A is attracted only when firm receives the shares, of unlisted company. Thanks to the law, which has not troubled the firm. Over and above that, law is kind enough to say that firm can very well take the cost of acquisition at 50 lakhs. Write down. That is, point is that 50 lakhs, what I am saying, that the firm can take only when the partner is good-hearted fellow, because now we have explained that particular provision to him. He knows that even if he makes the firm to record at 30 lakhs, he is paying the tax at 50 lakhs by taking 50 lakhs as a deemed sale consideration. In the presence of this law, no partner will make such kind of act. He will very well, ask the firm to record the same at 50 lakhs. because even if he don't say to record it at 50 lakhs, he is paying the tax by taking deemed sale consideration at 50 lakhs. So no fool will ask the firm to record it at 30 lakhs and offer the income at 50 lakhs. The firm, for it won't make any difference, because it will record the same at 50 lakhs, because the partner is asking the same to be recorded at the stamp duty value. If such kind of thing act is resorted, firm can very well take the benefit of 50 lakhs as a cost of acquisition. It is not automatic, kindly remember. That is since what is it, it is taxed in the hands of the partner at by taking a deemed sale consideration as 50 lakhs, that will be automatically adopted as a cost of acquisition here. That is not the point we are driving. After understanding this particular provision that there is a stamp duty value concept, partners will automatically will make the firm to record the same at 30 lakhs, so that the firm can take the things at that 50 lakhs recorded value. Other way around, if somebody unknowingly do this kind of crime, then firm at what value it is recorded in the books, that only will be its cost of acquisition is a point. Because sometimes to purchase the piece, what will happen when scrutiny, surveys, search, all these things happen, department will add some amount without attributing any reason, and to purchase the piece we accept it, because we know what are our loopholes, right? Let us suppose I am showing my business income as 30 lakhs. That fellow said these are the expenses which are going to be disallowed. You bring the books. So anticipating so much of the harassment, I said, sir, you please tell me what you want to make an addition. Bring in the books, yes, sir, kyon sahab? Okay, I am adding 20 lakhs. They have added to my income. In the next year, can I show that since a 20 lakhs of addition is made to my income, this can I show it as a source? If I show it as a source, that means openly accepting that there is an undisclosed income, right? Then penalties will be levied, right? See, only to purchase a piece you have accepted for the addition. Now next year if you show it as a source, what will happen? That means you have accepted that there is an undisclosed this thing. Then you will be troubled. So similarly here also, there you made it to be recorded at 30 lakhs. So firm, it has to show it only as a cost of acquisition as 30 lakhs. But you have to offer 50 lakhs as the deemed sale consideration and you have to pay the tax. Can you tomorrow go and argue that, sir, when we recorded the same at 30 lakhs, you have added 20 more lakhs and brought the say deemed sale consideration as 50 lakhs, then why don't you give that benefit to our firm and treat the cost of acquisition as 50 lakhs? No, that you should have done it earlier, not after our invoking the, what is it, 50C is the point. That's where chartered accountants are required for companies and the firms. Knowing well all these things, properly you will be able to plan it, right? That's where a tax consultant and a chartered accountant should differ. A BCom and a chartered accountant should differ. When you go for audit or when you are looking at the accounts of somebody, from all angles you have to think: company law angle, audit angle, tax angle, excise angle, customs angle. That's where the balance sheet is being sent to your office, because you are an expert knowing all these things, right? So now we completed 45.3 and we also enjoyed the provisions of 56.7, 56.27 and 56.27A. 27A is in case of unlisted shares are being transferred to the firm. Then in the hands of the firm, the difference between the fair market value and the, what is it, the value at which it is recorded in the books will be treated as its income from other sources is a point. And in case of the land and building, if you are doing such kind of the act, then stamp duty value will be evoked and partner will be troubled is a point, not the firm. Because the provisions of 5627A are applicable only in case of the unlisted shares, not with respect to the land and building. Moreover, firm will not be troubled by invoking 5627, because 5627 is applicable only in the hands of the individuals and the HUFs and not in the hands of the partnership firms. Then I move quickly to the 45.4. What is 45.4, friends? Dissolution of the partnership firm and assets being distributed to the partners. Very simple provision. See, many of the partners, even after fighting, will still remain united at least till 31st March. Why? Because of 45.4 only. I am fighting with my partner like anything. The next moment, if we dissolve and distribute the capital assets, what will happen? Firm need to pay the capital gains tax by taking the difference between the fair market value of the asset which got distributed minus value at which minus cost of acquisition or the indexed cost of acquisition is a point. That is the reason why when two partners quarrel and come to our office, we will tell that please give me the time. Meantime, what I will do? I will give the assets to the partners by keeping the firm alive, and after all the assets are being given to the partners and nothing is there in the balance sheet, then I will go for the dissolution. Other way around, firm got dissolved, assets are there in the balance sheet and you distributed the assets to the partners, then the firm is liable to pay the tax, capital gains tax, which is the difference between the fair market value of the asset as on the date of the distribution minus the cost of acquisition or the indexed cost of acquisition. I am not making you to write that. Anyhow, that will be there in the notes. Now the point here is stock in trade. Firm got dissolved, then stock in trade is there. Law says what? Take the fair market value of such stock in trade and fair market value minus the value at which it is there, that difference you are liable, firm is liable to pay the tax. That's the reason why dissolution of the firm, कोई भी आए तो उसको क्या बताना, जरा ठहरो, पहले पूरा बैलेंस शीट को क्लीन करके बाद में डिसॉल्व हो जाओ, नहीं तो so much of the things are there in the law. Firm got dissolved and business got discontinued. Supreme Court judgment in ALA firm. What is it? That such a stock in trade must be valued at what is it? Fair market value, and the difference between the fair market value and the book value must be treated as a profit and gains from business and a profession. Right? There is another case called as Shakti Trading Company, in which Supreme Court said, if the firm got dissolved and one or the other partner is continuing that particular business, firm got dissolved but business got continued, then the stock in trade you are asked to value at cost or market value, whichever is a lower is the point. Please do remember, firm got dissolved and such a dissolution and this 45(4) provisions apply even when one of the partner got retired, because at your PCC level you studied what are the situations in which the firm gets dissolved. On admission of a partner, on retirement of a partner, on death of a partner, these are all the situations when the firm gets dissolved and gets reconstituted, other way around. So your 45(4) is even applicable in a situation where that is one of the partner gets retired also is the points. So that's why we say the word otherwise used in section 45(4) not only covers the case of the dissolution but also covers the case of a partner retiring from the firm and asset is given to him. We are 4 partners, one partner got retired, we have given one asset to him, 45(4) is to be invoked. We reconstituted the firm, so 45(4) do makes an application there. So these things, quickly make note of few points here. When firm gets dissolved, 45(4), when firm gets dissolved oblique partner retired and assets got distributed to the partners, then firm is liable, then firm is liable to the capital gains tax. And capital gains is equal to fair market value of the assets on the date of distribution, minus cost of acquisition oblique indexed cost of acquisition, minus cost of acquisition oblique indexed cost of acquisition. Whereas with respect to the stocks you get PGBP, that is, next point you write, when firm gets dissolved, then its stock in trade is to be valued at fair market value, and the difference between the fair market value and the book value of the stock, fair market value and the book value of the stock shall be assessable as PGBP. What is PGBP? Profits and gains from business and profession. But please do remember, this principle is applicable when the firm gets dissolved and the business got discontinued, right? If the firm gets dissolved and business is continued, then the principle is stocks are to be valued at cost or market value, whichever is lower. Just these two cases reference you can keep. Supreme Court judgment in ALA firm, Supreme Court judgment in ALA firm, firm got dissolved, Supreme Court judgment in ALA firm's case, ALA firm case, firm got dissolved, business got discontinued, then stock is to be valued at FMV, fair market value. Next, Supreme Court judgment in Shakti Trading Company, Shakti, SAKTHI, Shakti Trading Company. Shakti Trading Company. Firm got dissolved and business got continued. Firm got dissolved and business got continued. Then the point is, stocks are to be valued at cost or market value, whichever is lower. Friends, try to understand. Firm and company, these two greatly differ, at least as far as this provision is concerned. In case of the firm, क्या हो रहा दोस्तों? When the firm gets dissolved, firm is at a trouble because your 45(4) is asking the firm to pay the tax, and individual partner is happy. He is not subjected to the tax. कंपनी में ये नहीं होता. कंपनी में क्या है? Your 46(1) says what? When company gets into liquidation and distributes the capital assets, it is not to be regarded as a transfer. No capital gains in the hands of the company. 46(2) says what? That is in the hands of the shareholder, that is two incomes will arise. One is capital gains, another is a deemed dividend. Because at the time when the firm is getting, when the company is getting liquidated, if there are any accumulated profits, to the extent of the share of the individual shareholder in that accumulated profits, you should treat it as a deemed dividend, and any excess amount of the profit is to be attributed as a capital gain. So these two are tangentially different. Firm केस में firm dissolve हुए तो firm tax pay करना पड़ता. Company केस में company is scot free, individual shareholder is liable for the tax, is the point that you should be clear with. So one small point you write. Excess amount received by the SSE, excess amount received by the SSE on retirement from the firm is not accessible to capital gains, but it is also another Amrutanjan program. क्या है? This is also another Amrutanjan program. Let us suppose I am a partner, my capital is 10 lakhs, मगर firm dissolve होके हमको 50 lakhs दिए. Capital gains तो नहीं होता, क्योंकि we can't transfer our share of profit in the firm to anybody else. It's not a transferable item. If you read Partnership Act clearly, you can't give up your this thing without the consent of the other partners. It's not a freely transferable item. But what the law says, if your argument is like that, the case has gone till Supreme Court. CAT versus R. Lingamallu Raghu Kumar case, it is stated that the difference between 50 lakhs and 10 lakhs जो है ना, उसको हम income from other sources बता के 56(2) clause 7 को invoke करके पार्टनर को वो 40 लाख के ऊपर 40 lakhs के ऊपर we will ask the partner to pay the tax. Where is the relief? There you say no capital gains, or other way around, I fought till the Supreme Court and made the Supreme Court to say that yes, what SSE is saying is correct. That is, when he gets out of the firm, what he receives from the firm is for not transferring his right in that particular firm. So no capital gains arises. But immediately having lost the case in Supreme Court, the department will go and cry before the finance ministry. Finance ministry will bring a beautiful provisions like this 5627. So write down. That is excess amount received. वो लिख दिए आप. Excess amount received by the SSE on retirement of the firm is not accessible to capital gains. However, such a excess will be subjected to tax in the hands of the partner as income from other sources under section 56 subsection 2 clause 7. One noteworthy point is depreciable assets के लिए तो ये principle नहीं है. In case if the partner is receiving any depreciable assets, then even if he receives such excess, your 56(2) clause 7 will not get invoked. Write that note. That is, if a partner on his retirement receives his machinery, then provisions of section 56(2)(7) does not apply. Does not apply. Right, friends. One more last point here is firm getting converted into company. Firm getting converted into company is also a matter of dissolution. तब तो ये 45(4) will not get invoked. Write down. Because your 47 clause 13 says subjected to the satisfaction of the conditions. Conditions बता दिए 47 clause 13 में. When firm gets converted into company, then provisions of 45(4) shall not apply if provisions of conditions stated in 47 clause 13, if conditions stated in the 47 clause 13 are met with. If not met with, if those conditions are not met with, what are those conditions? All partners in this particular firm must become the shareholders in that particular company, and they must hold at least a prescribed percentage of the shares there, and they must hold the same like for prescribed number of years. All those things we will study in the next sessions to follow, but as a point you should remember this. These are the very important points. Quickly I will sum up 45(5). Friends, what is 45(5)? When the asset gets compulsorily acquired, already we have discussed, year of chargeability is the year in which first compensation is received. Benefit of indexation is restricted only up to the year of compulsory acquisition. Let us suppose one person is not happy with the compensation. He files a suit in a court, and court awards additional compensation, further compensation. Your original cost of acquisition will be allowed as a deduction against that initial compensation. So against the additional compensation, nothing will be allowed as a deduction, entire amount will become taxable except the legal expenses which you incurred to get that particular compensation. Nothing else is allowed to be deducted because entire cost of acquisition is initially being deducted against the initial compensation. स्टोरी वहां स्टॉप नहीं हुआ. Let us suppose, right, let us suppose that is, if the case is fought and we lost the case in the Supreme Court, compensation is reduced instead of enhancing, or earlier enhanced one at High Court level is reverted back by the Supreme Court, then earlier assessment is to be rectified, modified, and the assessee need to pay the refund it and get what is the tax earlier he has paid, it will be given back to him. And as a last point for this particular session, please remember that in case of the compensations, because of the delay, you are going to get the interest. Such a interest will be treated as income, will be taxed under the head income from other sources, and there is another beautiful deduction against that particular interest for the delayed payment. 50% of such interest will be allowed as a deduction, and remaining 50% you should offer as a income from other sources. With that, I concluded the the chargeability section. In the session to follow, we will take up what are the transaction not to be regarded as a transfer, and then exemptions under section 54 and the 40 to 45 previously suggested questions. Thank you.